Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. It's a quiet economic day, which really gives us time to step back or to go up to 60,000 feet, which is the purview of Betsey Stevenson out of Wellesley College, the land of Carl Case long ago, rigid economics to Harvard, and then to really holding court and building a huge public policy franchise at the University of Michigan. We're honored to bring you Professor Stevenson to start things this morning. Betsey, Gerald Ford had an inflation scare, and he put out buttons that said whip inflation now. That really didn't work. Betsey Stevenson, what should be the policy prescription for our next president of the United States to whip inflation now?
Well, I think we've actually done a pretty good job whipping inflation now. It's interesting that you asked, sort of what should the president do? Most people think that it's really the purview of the Federal Reserve to handle inflation. And they do that by trying to make sure that demand is in line with supply. And what we saw in the United States and frankly around the globe was demand got ahead of supply. And we've seen that normalization start to happen in a way that, we did see rates rise all over the globe, but we've also seen inflation come down. And it's come down with a lot less pain than people anticipated. And I think that was because supply expanded. We didn't just need to bring down demand, but we got to expand supply. So I give you that whole long answer because I think it does bring us back to what can presidents do? Well, presidents can make sure that we have an environment that allows new businesses to thrive, that allows new businesses to form, to expand, that allows hiring to continue in a way that is bringing additional people into the labor market.
Betsey,
I think that's one of the things that people get confused about. They see a hot labor market and they say, oh, maybe that's bad for inflation. Right. Only bad for inflation if we can't find the people to hire.
Betsey, the mail that Paul Sweeney and I get is simple. They have fixed costs. America has to eat, and America has to find a place to sleep. And housing is a disaster. Rent increases for a lot of people. I understand in the West, particularly, rents are coming down. But the combination of housing and food leads to an American public buried from 2019. Can we establish a policy to assuage that pain?
I think there are two separate things here. So when we think about housing, the main issue with housing is always going to be, why aren't we building enough housing? Prices go up for housing when there's more people who want housing than there are houses out there. I sort of laugh because I literally got an email from a neighbor in the last couple days telling me about a horrible policy that the city wants to pass in Ann Arbor, Michigan, that would increase density. For the horrors, increased density. And the reality is we need to increase density. If we're not increasing density, we're not going to bring down prices because the only way to bring down prices is to build more supply, and that involves having higher density. So I think housing is one of these things where, honestly, progressives get themselves really worked up about it, and then progressives also push policies that reduce housing supply. So we've got to face the music on that one. I think it's very, very different from grocery price inflation. I think grocery price inflation, it is really the grocery prices aren't going to come down, but they are going to stabilize, and they already have stabilized. And I think we're just going to have to adjust.
So, Professor, can you talk to us about the labor market here? We've seen some really strong labor data recently. I mean, the labor market's been so resilient here. Can you give us your thoughts on kind of how you view the U.S. labor market, particularly as it relates to immigration and how that may be impacting the numbers, because labor is obviously something that the Federal Reserve is looking at?
Well, that's what I was saying earlier, is that what the Fed cares about is we think that the labor market could be inflationary if the companies are trying to hire and there aren't any additional people to hire. So what will they do instead? Well, they'll start competing over employees, and that competition will push up wages, and that pushing up of wages will spur inflation, because if you're paying your workers more, ultimately you're going to charge your customers more. Now, if instead, when you go to hire, there's some new people who enter the labor market, in other words, the labor market's expanding along labor supply is expanding along with labor demand, then we don't get any inflationary pressure. We actually get the opposite. It actually reduces inflationary pressure. Right. How do we get the labor market supply to expand? There's only two ways. The people who are already here become more likely to work, or we bring in new people who are willing to take the jobs. And what we've seen are both of those things have happened, but really immigration has been important.
Okay, Betsey, I got 1 minute left. I got Michigan out of state at $77,000 a year. We just published Vanderbilt near $100,000 a year. When are we going to get a handle on the madness of college cost?
I think, again, it's a really complex issue. The question on college costs are, what are they paying for? What are they getting? And how are we going to fund it? There's tuition, and then there's, all sorts of things that people do on campus. Right. I think we got to decompose that. And then the last thing to note is, remember, those sticker prices do not reflect what most people actually pay. So as long as we have rising inequality, we're going to have higher sticker prices so that we can have the people who are paying the most help subsidize the people who can't afford that.
But never enough time. Betsey Stevenson, thank you so much. Truly one of America's best thinkers about our fractured political economic policy. I have tried for over 3 weeks to get this guy on. This is the single best gold analyst on the culture and fabric of gold worldwide I know. He's with a small bank, the Hong Kong, Shanghai, and Banking Corporation, and we are honored to bring Global Wall Street James Steele. James, the back of the postcard analysis is China. China at the margin is buying up all the gold. Who are they buying it from?
Well, good morning, Tom, and thank you for having me. I think much of the reason is not just China, but abroad, and it's the same reason. It's a default play. In the case of China specifically, the property markets have been very weak. The equity markets have been very weak, and this narrows the universe that investors, big and small, are likely to look for. And gold is a great safe haven. Now, we're seeing the same thing abroad, but the equity and property markets haven't fallen abroad. And in the case of Western markets, I think what we've seen is asset managers, portfolio managers, and the like have recognized that equities are very high. They have no choice in many cases but to be in the equity markets, but they do have a choice about how they hedge that exposure, and they've chosen gold.
When the Chinese buy gold as a general statement, is it bars of gold? Is it old Krugerrands? Is it bracelets? Are they down at Tiffany's in Shanghai buying some gold bauble? What do you buy when you buy gold in China?
Well, it's a mix between China and India. 50% of all the gold jewelry in the world is bought. And roughly, it's a 2/3 jewelry and 1/3 bar and coin.
So,
And the investors who are looking specifically to hedge themselves more from equity market and property market weakness, will favor the bar and coins.
so do we have a sense here where gold should be? I mean, it just is set all-time highs every day. I'm not sure people have a sense of how to value this thing.
Well, yes, I would agree. And I think that's a universal problem where certainly to look at costs of production won't help you at all because the market is well above the average all-in sustained costs of production or any measure that you want to look at, with maybe except for one or two gold mines in the whole world. What you would, and some of the traditional barometers also are not working very well. For example, we were looking for 150, 160 basis points. When I say we, I mean Wall Street in January. That's contracted to below 75 basis points of cuts. That would normally have led you to think that gold would recalibrate lower between January and now. But the opposite has happened. Real rates are positive. That should be providing headwinds. And the dollar has been reasonably firm. None of those things seem to be making a huge impact. And what I would add is I think the geopolitical element has been very strong. We've seen a lot of geopolitically led safe haven buying coming in. And there's academic studies to show that gold hedges well against geopolitical risk as well as it does against financial market risk. So I would say right now we are in a bit of a no man's land here where the traditional issues are not having, would not provide you with the guidance that you would normally think. Now, over time, physical demand outside of China is suffering. It was down last year in India. A 10-gram bar in India is now 71,000 rupees, double what it was just a few years ago. Jewelry demand is declining. Most people that bought coins have already wanted to buy coins have already done so. And I would suspect that if we get an equities correction, and I'm not saying that we will, that's well outside my pay grade, but that itself could bring an end to some of the safe haven portfolio-led buying that's coming into gold.
Right.
So those things.
That's a Chinese central bank That's a Chinese central bank on the line.
Putting an order in.
Steele, being sure he understands they're buying this morning. Paul, jump in with a question.
Hey, James, just looking again, gold's had a great run here, up 14% or so year to date, but silver up over 16%.
Oh, listen to you.
I'm looking at my GLCO page on the Bloomberg terminal, global commodities prices, and I see that silver's up over 16%. What's the driver there?
Well, there I think we have more of a fundamental reason. The industrial demand is very good for silver, particularly photovoltaic. Now, there has been a catch up with gold for many, many months. Silver did not rally in the wake of gold. And I think it's been recognized that it's undervalued compared to gold. So vis-a-vis gold, there's also a bit of catch up to do. But even here, as we get above $27, there's a lot of silver in the world and there's a lot of it above ground. And we're going to see more recycling. And we see very heavy recycling, particularly when we get to the $30 mark, as we did back during the Reddit fiasco and the silver ran up to $30. We saw a lot of recycling. And I think we can expect the same thing if silver gets up there again.
Okay, James, help me here right now. I mean, Lisa and I were talking this morning, and she's got her eye on the Elsa Peretti Aegean necklace at Tiffany's in silver for $5,400. To Paul's good question and Lisa's interest in the Elsa Peretti Aegean necklace, is silver investable or emotional like gold?
Silver has a much greater industrial component. 55% of silver demand is in industry, goes to industry and manufacturing, whereas it's just 6% or so in gold. But it is a smaller market in the sense of on the financial end of it, and so it can be moved very quickly. And typically in bull and bear markets, silver will outperform gold both to the up and the downside, but it hasn't done that this time. Gold has led the way.
Right.
No, it is an investable metal and it is a precious metal, but it
Right.
doesn't have the financial market purview that gold has.
James Steele, honored to have you on. James Steele, he'll be on Single Best Idea today. Have to have him on. He's a legend with HSBC there.
Hope to see you again anytime.
We'll see
Thank
you.
you.
Well, James Steele, we'll see you again at gold 4,000 an ounce. How about that? Right now, Ann Sonders on the equity markets. Ann, we got to be quick here this morning, but it's simple. We've been talking about we just can't correct. Why do we not go down 10% is a normal and healthy market event?
Well, let me give you the actual stats, Tom. You've had no more than a 2% drawdown in the S&P year to date at the index level, only 3% for the NASDAQ. But the average member maximum drawdown for the S&P is negative 10%. For the NASDAQ, it's negative 28%. So you've had corrections under the surface. It's just happened via a process of rotation. That's not a bad thing. I think everybody would probably choose that version of a correction, whether it's just correcting excesses or correcting concentration. Not a bad backdrop.
Can this market work higher if tech is not leading?
Yeah, in fact, tech hasn't been leading over the past month or so. You've seen energy at the top. Energy's got 100% of its stocks trading above 50-day moving averages, and behind that are sectors like materials and industrials, financials, even to some degree, and utilities. So yeah, we're seeing it.
Away from your remit, but what does CPI matter tomorrow, Ann Sonders?
It shouldn't matter just at the flash of the level, either on headline or core. I think what's important now, given that the Fed's focus is on PCE, core services, ex housing, is how CPI and in addition PPI kind of maps to what the PCE reading. So I think what will be more important is economists in then figuring out what does that mean for the next PCE print. I think that's what should be focused on.
If we have resilient, it's like an alphabet soup, CPI, PPI, PCE. If we have a resilient inflation, Ann Sonders, does that suggest higher revenues due to a more buoyant nominal GDP?
Well, that's certainly what we got during the higher inflation era.
Yep.
You saw very strong top line growth. You didn't see it in terms of bottom line growth because there was that larger differential that brought real change much lower. But yeah, all else equal, I think it boosts top line. But the margin story is what comes into play as it relates to the bottom line.
Ann, we get earnings kicking off in earnest later this week. What do you expect to see? What do you think the market needs to see?
Well, expectation is around 5%, and then it trends higher. The consensus right now for calendar year 2024 is about 10%. But I think it's not just things like the beat rate and the percent by which companies have beat, but what the outlook is for the latter part of 2024, because that's embedded in forward PE. And I'm not sure there's a lot of confidence in the out quarters. So it's not just the current season, but the outlook, not just for earnings per share, but also the profit margin story.
You've been doing this a few years. What do you make, Ann Sonders, of James Dimon's 62-page MD&A? An MD&A, when you study the CFA, was like 2 pages long, and it was written by 4 people in PR. I think it's a jewel, Ann. What do you think of the value of a 62-page MD&A?
Well, I can't actually answer that because I haven't read the 62 pages yet. So I've just seen headlines. He certainly provided a pretty wide range in terms of inflation and rates. I think I saw some reference, to 2 to 8%. So I got to start talking in wide ranges like that because it basically, sets up that you're not wrong. You can say, and I nailed it. So it's on my reading list.
It's on her reading list, but she's actually dead on about CEOs, Paul, taking a wide view to say this. Why don't you get one more in?
Ann, how about valuations in this market? We've had that big move off of the October lows here. Are we really running up against some valuation parameters?
Yeah, I mean, you got 21 on forward PE. It's less if you take some of the mega cap names out. The rub is that valuation is stretched, it's rich, whatever term you want to use, but it's a terrible market timing tool. Just like sentiment. Sentiment's frothy. It's a terrible market timing tool. So sentiment can be frothy and valuations can be rich and they can stay there for years, as we all learned in the late 90s. So as a backdrop, I think it's a risk factor, but it doesn't tell you anything about timing.
Liz Ann Sonders, thank you so much. Greatly
Good to see you.
appreciate it. Bloomberg surveillance and our newspaper, the Lisa Mateo Hour. Lisa, you survived the eclipse?
I did, but I didn't get to see it. One, I didn't have the glasses, and two, the clouds rolled in.
The clouds rolled in.
So you had all the kids outside looking up, and there was nothing to see.
I thought of you yesterday because in my little area, a bunch of people came out and they did not have glasses. Fortunately, I had extras, so I was the glass
Saved the day.
bearer here. And I was thinking, who would not get glasses, or who would get the wrong kind of glasses? Who could ever
Someone
do
like
that?
Lisa Mateo would do that.
That would be me.
What do you got today?
Well, it has to do with that because how are people's eyes feeling this morning? Do you have dry eyes from kind of looking too long, or is it something a little bit more severe, like retinal damage? This was actually from the Washington Post. Pretty interesting. Experts are saying if you use the glasses, you're fine, but there were the fakes out there too that you also have to be wary of. But if you have symptoms like soreness, pain, blurriness of vision, if you see gray spots that don't go away, they're saying check with your doctor. And it doesn't happen right away. This can take a few days, a few hours to emerge after kind of looking at the sun for a long time. But the thing to consider is how long your symptoms last. So if these things persist over after using eye drops, if you still see blurry, if you still see things like that, definitely call your doctor.
And this is really helpful. Thank you for doing this, Lisa Mateo. But the answer is it's not right away. It can happen now. It can be 2 days out, 3 days out, a week out.
No, definitely. So it's just consider. This also has to do with the eclipse. So Airbnb bookings, they surged during the eclipse. A lot of people, Airbnb says 25% of its guests in the U.S. with bookings for Sunday night were for a stay in that path of totality.
It's a great map in that story.
Yeah.
It just shows you coming out from Texas all the way through Maine. Unbelievable.
It's crazy. And even top holidays like Memorial Day, Labor Day, 4th of July weekend. So it was big. So it shows that Americans like this, experience travel. Yeah, right. We should have more eclipses more often. But they're saying 2024 travel, though, looks a little bit weaker. A lot of it depending on China, what's going on in China. Airbnb, bookings, holding Expedia, they've all said that they expect things to kind of slow down toward the end of the year. People not traveling as much.
All right. I'm traveling.
But Paul's saying he's going all in.
I just paid for economy seats across the pond. I was shocked what it cost.
Oh.
I just, this idea that it's pulled back, I'm like, show me, please. Show me. What else do you have?
Oh, this one I really like. This was from the New York Times. A Brooklyn school is keeping its doors open for 12 hours. This is going to help parents the working families. It's going to help increase enrollment because enrollment has been down. The kids may not be thrilled about it all the time, but a lot of the kids, though, wanted to stay, and they wanted to stay extra. So it's Brooklyn Charter School in Bed-Stuy, open 7 a.m. to 7 p.m., all completely free. Okay, the sharp decline in students in urban schools, parents working longer hours, right? You have the long waiting list for after-school programs. A lot of people can't afford it as well. So they're testing it out. So they read books like at 7 a.m., before school starts at 8:30. They go straight through school at 4. And then from 4 to 7 p.m., they get meals, they get served dinner, they do some extra activities, and they get to sit down and do their homework too. So they're testing it out to see how this works out.
It's a whole new world. I mean, it's just so different from.
And I wonder why enrollments are down, just in general.
Well, they're saying a lot of people, especially in inner cities, they left during the pandemic, and they haven't come back.
Gotcha.
And that they lost nearly 30% of students during the pandemic at that school.
A lot of people of means, moved out to Long Island, and they haven't come back. It's just that as simple. It sort of goes to that idea. What is it, Paul? Wednesday's the busiest day of the week in Manhattan now.
Yeah, I'm looking at people as we speak coming down the curved escalator at the Bloomberg HQ.
Building out to the big Wednesday.
Yes, exactly.
I think it's nuts. Don't get me going. they're going to get in trouble. What else, Lisa? What else?
And finally, Utah. It's become the tech hub power of America's job market. So this is a Wall Street Journal study with Moody's Analytics. The rankings determine the strongest labor market based on 5 things, okay? Was the unemployment rate, the labor force participation rate, changes to unemployment levels, and also the size of labor force and wages. So here's what they found out. Salt Lake City, the country's hottest job market in 2023. You've been there, Paul.
Sure.
You know about it. It was followed by 3 cities in Florida, Jacksonville, Orlando, and Tampa. Miami also made the top 10, but they're calling it the Silicon Slopes.
You know who I think was kind of one of the first major companies to move out there was Goldman Sachs about 10 years ago.
Okay.
A neighbor of mine was the COO there, and it was his thing to think about where do we go with our big operations thing, and they chose Salt Lake.
Where are we
and
in 10 years? Where are we for the census of 2030? I mean, I looked at the list, and it's not just Utah. It's Austin, Texas is up there, and all the other usual names. They're all Southern. They're all sun.
Right.
They're all away from the ridiculous rental, dance that we do here in the tri-state area, and frankly, other major East Coast cities. Where are we in 10 years? Paul, where are we?
I think the trend. I mean,
Key
the trend
West?
in our entire, at least my entire lifetime, it's been the Sun Belt. And we've been pitching the Sun Belt for 30 or 40 years, and it just got another, just a surge here during the pandemic. Why not?
So we could get a cabana next to, I think McGlone's in Coral Gables, right? I mean, he's got 6,000 square feet in Coral Gables.
He's got the penthouse.
He go down to the Breakers if he has to. But the bottom line is we can move the whole. Well, Lisa, can you move to Florida with us?
I wouldn't mind. I have family there. Let's go.
Let's go. I mean, what do you think? Ken Filio, what do you think? Our global technical director. Can you move the kids to Florida?
He's not going
anywhere.
See him?
Yeah. Ken's like,
well, they're saying the younger generation is doing that because they have this love for the outdoors too. So Salt Lake City has that. They have the mountains.
I was thinking
the great thing about Salt Lake is
you
you can be at the world-class skiing in 40 minutes.
See?
None of this crazy I-70 stuff from Denver up to the mountains, which is like the death march. This easy little drive right up to the mountain.
The difference is Lisa's in Florida in the Everglades looking for pythons.
Yep.
I'm on the deck of the Betsey Hotel looking for a beverage. I mean,
exactly.
That's a difference. Lisa Mateo there with our newspapers today. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.